Welcome to the deep dive. Today we're looking at Applied Digital, that's ticker APLD. They've really shot up, positioning themselves as builders of, well, AI factories.
Yeah, exactly. If AI is the new gold rush, APLD, they're not digging for gold. They're selling the picks and shovels, or maybe more like the entire high-tech mining operation complex, these high-performance computing centers.
So our mission for this deep dive is pretty clear. Is APLD a truly essential infrastructure player in this whole AI build-out, this land grab, or is it, frankly, sky-high valuation, mostly market hype?
And we're working with data as of October 21st, 2025. The share price for reference is sitting at $35.28.
Okay.
And right away, here's the challenge for you listening in. This stock, it's incredibly polarized. I mean, on one side, APLD have these just massive strategic wins, huge validation for their model.
Right.
But then the valuation is, well, it's extreme. We ran the fundamental model, and they point to an intrinsic value somewhere between, say, $7 a share on the low end and maybe $27 optimistically.
And it's trading at over $35.
Precisely. It's significantly above even that optimistic $27 mark.
Yeah.
So that gap, that huge difference, that's the core puzzle we need to unpack today.
Okay. Sounds like a fascinating high-stakes situation. Let's definitely get into it. We'll start with the core foundation, the absolute essentials of the business. Chapter 1, business understanding. So maybe the single most critical piece of the APLD story is their big strategic pivot. They weren't always doing this. They started out as applied blockchain, right? Focused on crypto infrastructure.
That's right. But management, they saw the writing on the wall for certain crypto models anyway, and pulled off this really fundamental shift. They rebranded, refocused the whole company on high-performance computing HPC and these custom-built AI data centers.
And that pivot, that's really the bedrock for everything else we're going to talk about.
Absolutely. It's a textbook case of adapting. And it led them to this kind of hybrid revenue model they have now. The main engine is HPC data center hosting. Think long-term leases, basically being a specialized, super reliable landlord for compute power.
And the cornerstone deal there, the one that really put them on the map in this space, is that massive contract with CoreWeave, the AI cloud company.
Yeah, that's the one. A 15-year lease. And it's projected to bring in something like $11 billion in revenue over that term.
$11 billion. Just having that contracted revenue must provide a huge cushion for a company that's still, growing so fast.
It's enormous visibility. Beyond that core hosting, they also have cloud services. That's their GPU as a service. Higher margin, more subscription-like income.
Okay.
And then there's tenant fit-out services, so custom builds for clients. That actually brought in a decent chunk, $26.3 million, just in the first quarter of fiscal 26.
So multiple streams there, and their whole pitch, their tagline, sums it up, right? Dirt to compute.
Exactly. They managed the whole complicated process end-to-end, building these very specific AI factories. But where they really stand out, their durable advantage seems to be on the cost side, operational cost.
How do they manage that?
Two main ways. One, they locate facilities near what's called stranded power. Basically underutilized energy, often renewable. Two, they leverage cooler climates, like North Dakota, for free cooling. Less need for expensive air conditioning.
And that's not just marketing fluff. Those are real savings.
Oh yeah, significant. They estimate for a big customer, say 100 megawatts, the savings could be up to $2.7 billion over 30 years compared to building in a typical urban data center hub.
That's a massive structural cost advantage. And then there's the speed factor, too.
Right. Speed to market. They've streamlined their design, pre-purchased critical gear. They claim they can cut build times from maybe 24 months down to 12, maybe 14 months.
In this AI race, getting compute online faster is, well, it's incredibly valuable.
It's a critical edge.
Yeah.
And it also creates a pretty big barrier to entry. You ask, why can't someone just copy this? Well, the hardest part is securing hundreds of megawatts of power. And the land. That takes years, navigating regulations, construction. APLD's history in crypto actually gave them a multi-year head start on locking down those key assets. That's hard to replicate quickly.
Okay, that makes sense. So the model is clear, the advantages seem real. What about the team running this?
Good question. Let's shift focus there. Chapter 2, management evaluation.
When you look at the leadership, especially CEO Wes Cummins, you see a background not just in operations, but as a tech investor, right? From Nokomis Capital.
Exactly. And that background, I think, frames them less as just managers and more as strategic capital allocators. Yeah. They're constantly looking for where to put money to get the best return, which helps explain that big pivot.
Yeah, the pivot wasn't just a minor adjustment. You mentioned the crypto model becoming obsolete. Things like the China crypto ban really forced their hand.
It was a crisis response, absolutely. Their ability to navigate that, first shifting to Bitcoin hosting and then making the much deeper, much more complex jump to AI infrastructure. That shows real resilience, adaptability under pressure.
And their strategy since then has been all about aggressive growth, pouring capital into building, what was the figure? Over $1.6 billion invested in property and equipment.
That's right, aggressive organic growth. And a huge piece of validation and, frankly, de-risking came from that partnership with Macquarie Asset Management, a $5 billion preferred equity financing deal.
$5 billion, that's serious backing. It says a major financial player believes in their plan and helps fund future construction.
It does. But that kind of hypergrowth, it needs fuel. And that fuel, capital, has come at the cost of dilution for existing shareholders. The share count is up significantly, over 80%, to fund this expansion.
That's a big trade-off. We also have to mention the insider selling recently.
Yes, there has been significant selling by insiders. The context usually given is diversification after the stock price went up so dramatically. And CEO Cummins does still hold a very substantial stake. So it's not like they're all running for the exits, but it's something investors watch.
Okay. And because they're pouring all this money into building future capacity, their current profitability metrics aren't great, right? Like return on invested capital.
Right. The current ROIC is negative. It's sitting around minus 3.06%. But that's almost expected at this stage. They're spending heavily on projects like Polaris Forge 1 that haven't started generating significant income yet.
So the whole investment idea hinges entirely on the future ROIC from these new facilities, like that Polaris Forge 1 hitting its projected $500 million annual operating income run rate.
Exactly. It's all about future execution, delivering massive returns on the capital being spent today.
Okay, so we understand the strategy, the management's approach. Let's get into the current financial picture, the numbers as they stand right now. Chapter 3, Financial Analysis. So looking at the top line, revenue growth has been, well, explosive, but also a bit uneven. Went from $55 million in FY23 up to $137 million in FY24. Then it seemed to slow a bit in FY25, but boom, Q1 FY26 saw an 84% jump year over year as that AI pivot really started to pay off.
Yeah, the reacceleration is key. The trailing 12 months revenue is now about $174 million.
But, and this is a big but, that growth is costing a lot. This land grab cost, as you called it, profitability is just not there yet.
Not at all. Gross margin TTM is only around 14.5%. Operating margin TTM is deep in the red, minus 34.75%. And the big one for investors tracking cash flow, free cash flow TTM is massively negative, minus $1.31 billion.
Minus $1.3 billion. Wow. And that's almost entirely due to the huge capital spending on construction, right?
Precisely. They're building like crazy, and that burns through cash.
And you can see that financial strain in their liquidity metrics, too. The current ratio is low, 0.65. What does that signal?
It signals that their short-term liabilities are actually higher than their short-term assets right now, which means they're highly dependent on ongoing external financing like that Macquarie deal to fund operations and keep building. Their debt-to-equity ratio itself is moderate, 0.63, but the immediate cash flow pressure is real.
Okay, so fragile financials currently huge spending, which inevitably brings us to valuation. The market cap is over $10 billion.
$10.04 billion, yeah. And like we said, PE ratio is meaningless with negative earnings. So you look at price to sales, PS, and it's jaw-dropping, around 47.
47 times trailing sales. I mean, that's incredibly high for almost any company, but especially one burning cash and needing billions more for CapEx. Where does the market possibly find the justification for that multiple?
It's banking entirely on the future. It's pricing in flawless execution. It assumes that $11 billion CoreWeave contract is just the beginning, that APLD becomes the go-to builder for AI infrastructure, and that today's negative $1.3 billion free cash flow will translate into enormous positive cash flows down the road. It's pure growth expectation.
Which explains why trying to calculate an intrinsic value right now is so difficult and leads to such a wide range.
Exactly. Discounted cash flow analysis is really tough here. But the models, accounting for various scenarios, spit out that range we mentioned. Maybe $6.90 on the very conservative side, up to maybe $27 if everything goes perfectly.
A huge gap still compared to the current $35.28 price.
A massive gap.
Okay, before we dive into how the market is reacting to all this and the risks involved, just a quick reminder for everyone listening. If you're finding this deep dive valuable, the best way to support us and get even more content is to like and subscribe to Stock Analytics AI. For just $4.99 a month, Members get access to our full library that's 500 deep dives covering every single stock in the S&P 500. And we're launching our NASDAQ 100 coverage next, exclusively for members. Plus, if there's a stock you want analyzed, members can just drop the ticker in the comments and we'll do a deep dive on it for you. All right, so we've covered the business, the management, the tricky financials. Now let's look at how the market is actually perceiving APLD.
Okay, let's get into market perception. Chapter 4, Market Sentiment. So if you look at Wall Street analysts, they're generally quite positive. The consensus rating leans towards moderate buy or even strong buy.
Okay.
And their average 12-month price targets reflect that optimism, falling in a range from about $29 up to maybe $41 a share. So the institutional analyst community seems to believe management can pull this off, and there's still upside.
But that's not the whole story, is it? You mentioned polarization earlier. This sounds like a real battleground stock.
It absolutely is.
Yeah.
And the clearest evidence is the short interest. It is exceptionally high. We're talking 34.55% of the available shares, the float, are being shorted.
34%, that's huge. That means a very large, very sophisticated group of investors is actively betting against the company, betting that this valuation is unsustainable and the price will fall.
Exactly. It's a massive tug-of-war between the bulls who believe the growth story and the bears who are pointing to the valuation and the execution risks.
And technically, looking at the stock chart, who's winning that tug-of-war right now?
Well, technically, the bulls have had the upper hand recently. The stock price is significantly extended, as traders would say. It's trading way above its key moving averages, over 140% above the 50-day average, and even further above the 200-day average.
So strong positive momentum, but maybe getting a bit stretched, technically speaking, risk of a pullback.
Precisely. Strong momentum signals buying pressure, but that kind of extension often suggests it might be vulnerable to a correction if sentiment shifts.
Interesting dynamic. Okay, let's look at who actually owns the stock. That can tell us a lot about stability and conviction. Chapter 5, ownership structure.
So institutions seem to have pretty strong conviction here. They own a majority stake.
They do. Institutional ownership is solid, somewhere between 55% and 63%. That shows long-term funds are bought into the story. But maybe the most significant owner, or rather a strategic investor, isn't a traditional fund at all.
You mean NVIDIA?
Exactly. The fact that NVIDIA Core made a strategic investment in APLD is, well, it's a huge vote of confidence. Right, NVIDIA is at the absolute center of the AI hardware universe. Them investing directly in APLD validates APLD's technical chops in their role in the ecosystem, doesn't it?
It absolutely does. NVIDIA needs reliable partners who can build out the complex infrastructure required for their GPUs. Their investment is a powerful endorsement.
On the flip side, is there any concentration risk among the holders?
There is some. The top 14 shareholders control about half the company, around 50%. That provides stability as long as those big holders stay put.
But if one or two of those major funds decided to trim their position or take profits?
Exactly. It could create significant selling pressure just because their positions are so large relative to the daily trading volume. So it adds an element of potential volatility.
Okay, so strong institutional backing, key strategic partner, but some concentration. That brings us neatly to synthesizing all the potential downsides.
Right, let's talk risks. Chapter 6, risk assessment. So if we synthesize everything using a kind of SWOT framework, strengths, weaknesses, opportunities, threats, the key tensions really jump out. Their big strength is that specialized expertise, the to compute, the speed. But the flip side, a major weakness, is that customer concentration we talked about. So much of their projected future revenue relies heavily on that one CoreWeave contract delivering as expected.
Right. If anything happens with CoreWeave, that's a huge hit.
It would be. Then you look at opportunities versus threats. The opportunity is clearly the massive secular growth in AI compute demand, maybe even converting to a REIT structure down the line for tax advantages. But the overriding threat, the big one, is what we've been touching on. Financing and execution risk.
They're betting the farm, essentially, on being able to build these incredibly complex, expensive facilities perfectly, on time, on budget, again and again.
Billions of dollars are riding on flawless execution.
Sure.
Any slip-up in construction, any major delay, any significant cost overrun could severely impact their financials and investor confidence.
And external factors play a role too, right?
No.
Macroeconomics.
Absolutely. This is a very capital-intensive business. So rising interest rates make their borrowing more expensive, squeezing margins. Inflation drives up construction costs, materials, labor. Both of those directly threaten the profitability of these huge projects.
And geopolitical risks, supply chains.
Definitely a factor.
Right.
They rely on complex global supply chains for critical components. Think high-end GPUs from NVIDIA, specialized power systems, cooling equipment. Any disruption, whether it's tariffs, trade disputes, or shipping bottlenecks, can cause delays and cost overruns. Getting those long lead time items is crucial for sticking to that aggressive build schedule.
Okay, a lot of balls to keep in the air. So let's try and pull all these threads together now. Chapter 7, Conclusion. So, if we were to summarize the bull case for APLD, what are the core pillars?
I'd say it boils down to, 1, their strategic positioning as a specialized AI factory builder. 2, those durable cost advantages from stranded power and free cooling. 3, that massive de-risked revenue visibility from the $11 billion CoreWeave deal. And 4, the validation from powerful partners like NVIDIA and Macquarie.
A compelling story if they execute. Now, the bear case in a nutshell.
It's equally stark. 1, the extreme valuation, that PS ratio of 47, is hard to ignore. 2, the current financial fragility, negative free cash flow, low current ratio, dependence on financing. And 3, the immense operational execution risk tied to building billions in infrastructure flawlessly.
So investing right now at $35.28, it's not really about buying current assets or earnings.
Not at all. It's fundamentally a venture capital style bet. You're betting on this specific management team's ability to execute an incredibly ambitious hyper-growth strategy, navigate all those risks, and generate future cash flows so large that they eventually justify today's premium valuation.
It implies the path forward is likely to be volatile.
Extremely volatile. Success hinges entirely on perfect execution, quarter after quarter, year after year. Any stumble could significantly impact the stock price, given the high expectations baked in.
It really highlights why doing this kind of deep dive is so important, trying to separate the exciting strategic vision from the challenging financial reality. And before we wrap up with a final thought, just one more quick reminder: support our work and get access to hundreds more deep dives. Like and subscribe to Stock Analytics AI. It's just €499 a month for the entire S&P 500 playlist, our upcoming NASDAQ 100 coverage, and the ability to request your own stock analyses. Just drop the ticker in the comments for members. Your support makes this possible. Okay, so here's a final question for you to think about after listening. Given that massive short interest, that 34.55% bet against the company, what single strategic announcement could APLD make right now, something potentially even bigger than the CoreWeave deal that would absolutely force those short sellers to cover their positions, to capitulate? What would that game-changing news look like?
Something to ponder. And finally, please remember the standard disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Great point. Thanks everyone for joining us on this deep dive. We'll see you next time. And don't forget to like and subscribe to Stock Analytics AI.